bonds are an interesting investment vehicle which may suit investors in a range of different situations. Investment bonds are a tax-paid investment with a nominal 30% tax-paid rate. This means you would not need to include details of the investment, including earnings, in your annual tax return until a withdrawal is made. Earnings become fully tax-paid after 10 years. This means that the investment can be withdrawn at any time after 10 years and the proceeds will be completely tax-free, provided that the 125% rule has not been breached at any time. If any withdrawals are made prior to 10 years, a 30% tax offset can be applied against any personal tax on income or on capital gains. There is no limit to how many contributions you can make or how much the contributions can be in the first 12 months of the investment. However, in future years, contributions are limited to the 125% rule. This rule limits the contributions in the second year and beyond to 125% of the previous year's contributions. And the table on screen now shows the maximum contribution being made every year. If more than 125% of the previous year's contributions are contributed during any particular year, then the entire 10-year period will recommence. This means that the bond would have to be held for an additional 10 years from that point before being able to be withdrawn tax-free. An investment bond, therefore, is just a tax-paid vehicle for investing, and there's now a fairly wide range of underlying investment options available across most asset classes within investment bonds. And there are lots of people which may suit investment bonds, and I've listed out some of these circumstances. So, the too old. If you're too old to contribute to super and are still paying tax at a marginal tax rate greater than 30% and don't want the hassle of running your own investment company, then an investment bond may be a straightforward and very tax-effective alternative for you. If you're too young. If you're too young to consider contributing large amounts into super, or if you need to fund the retirement gap, then an investment bond could be for you. And the retirement gap is a number of years between when you want to retire and when you're able to access your super. For example, a 40-year-old today may want to retire at age 55, yet they can't access their super until age 60. They'll therefore need a different investment vehicle to provide for that retirement gap funding for those 5 years from age 55 to age 60. And an investment bond may fit this need. Similarly, if you are in your 20s or 30s, there may be other objectives that are more important to you, where you require a lower tax vehicle but don't want to lock the funds up in superannuation. And again, an investment bond may be the answer. Too much. If you have the ability to contribute the full concessional contributions to super, but don't want to exceed the contribution cap limit, where the excess would be taxed at your marginal tax rate, then an investment bond may be a sound choice for any contributions that would normally be in excess. The decision then comes down to making a non-concessional contribution to super from after-tax dollars, which in the future would only be taxed at 15%, but is not accessible until you reach a condition of release, or investing in after-tax dollars where future earnings are taxed at 30%, but which is accessible at any time. Too far. For expat Australians, they may have many reasons for wanting to remain invested in Australia due to differing tax rates in the countries in which they're working. As the income from an investment bond is taxed within the investment, it does not need to be declared on a tax return and therefore would be really appropriate for expats in that situation. An investment bond may also be an appropriate investment vehicle for family trusts, as again there is no distributable income from the bond. This may be important when there is a reason for both using a trust and wanting to keep investment capital intact in the trust. There's also an aged care strategy available within this scenario. To death. Okay, that was a little poetic license there, but investment bonds can be very useful in complicated estate situations as they can have a beneficiary attached to them. In this case, the funds would go straight to the beneficiary without having to go through a will, where the will may be open to a challenge. The beneficiary can receive the funds as a lump sum, as an income stream, or as a deferred payment, which may be useful for immature beneficiaries. If you have a complicated estate situation, then an investment bond may be a really useful tool. You may also use an investment bond to provide for a charity, a carer, or a particular beneficiary in a way that can't be contested and that is tax-free. Too educational. Investment bonds are very useful as education funding for either children or grandchildren, and I will be talking about this at greater length in a subsequent video. Education bonds can be commenced with either a lump sum or with a regular savings plan, making them very flexible. If you fall into any one of these different situations and think that an investment bond may fit within your overall financial plan, then please don't hesitate to contact us for further information.